Mike, before we get to that, do you think it's actually a real shift, a real change, or is it just jawboning?
I really think it's jawboning, Angeline. I think our markets have overreacted, I should say, somewhat to Mr. Weidmann's comments. I think it is a significant shift of position, and in that context, yes, it is a significant departure. But I think there's an awful lot of concern on the ECB Governing Council about the high value of the euro, despite the fact that the Fed appears well on the way to tapering its asset purchase programme. Despite that, the euro continues to move higher, and I think this is one of many measures that they're looking at sort of putting out there, if you like, to try and jawbone the euro lower. But before we even get to QE, and I think this is particularly important, before we even get to QE, I think the ECB has to acknowledge the fact there's a deflation problem. And Mario Draghi yesterday said that there wasn't. And then, of course, you've got the option of negative deposit rates, and that will come well before any prospect of QE, notwithstanding the fact that the German Constitutional Court has already fired a warning shot across central banks' bows with respect to saying that the OMT programme is ultra vires and as such is illegal.
Sure. Now, Mike, the euro did dip slightly following those comments against the dollar, but it did then come back up again. What is your forecast for the euro going forward the next 6 months, given if this jawboning continues in that time?
Well, I certainly think that the upside should be limited to around about 140, but that really is very dependent on the state of the US economy. If US economic data continues to improve, that should underpin the dollar and help keep a cap on the euro. So I'm expecting a range of in the region of around about 135 to 140 over the next 3 months.
Okay, Mike, we're also looking at Lloyds. Britain selling £4.2 billion of shares in Lloyds Banking Group at 75.5p a share. Chancellor saying it represents good value. Do you think so?
Yeah, absolutely. I mean, it's only half a pence above the previous placement of shares by the UK government, and it's part of the long-term plan to reduce taxpayer exposure to that particular bank. Lloyds is a success story, in inverted commas. The government has made money from it. I think there is some concern that the retail investor hasn't been involved in that. I think that could well come later this year, always assuming that the UK economy continues to improve, because rising property prices certainly helps Lloyds Banking Group. Its bad debts or its portfolio of bad debts, because essentially asset prices are continuing to rise. So from that point of view, a recovering UK economy continues to benefit the bank.